conversation going now. Cello World is in focus after the company reported their Q2 numbers on Saturday. They've reported a 4% increase in the top line on a quarter-on-quarter basis. The H1 revenue growth stands at 9%. But in the past, the company had indicated that they've always grown at 20%, and that's the growth rate we should expect going forward. So can they get back to that in the second half of the year, particularly given the festive season has fallen in Q3? Now, Q2 margins have declined by 60 basis points on a sequential basis to 24.6%. To talk about the outlook going forward, we have Pradeep Rathod, the Chairman and Managing Director at Cello World, with us now. Mr. Rathod, morning. Thank you for joining in. This is Reema here. That's the first question, right? H1 revenue growth is 9%. What can you do in the second half of the year, considering the festive season, bump up is going to take place in October, November, December? So that's question number one. And what has been the Q3 growth rate so far?
So if you see our growth, which is 9%, which looks a little lower because our raw material has softened in the first two quarters, whereby we have revised our price to an extent of around 5 to 6% on major of our categories. That's why the revenue growth is low. Plus the shift of the main festival season. Last year Diwali was in November, so September was the main month of sales. This year it is October. Going forward, H2, we are assuming with the muted raw material price, where the price correction is around in the term of 5 to 6%, is still going to be low for the next two quarters. And we see around 18 to 20% growth on a top line in the H2 of this year.
Okay, so H2 revenue growth will be at 18 to 20%. So in October and almost now November has come to an end, can you tell us the top line growth that you've seen given the festive season?
So I think so the top line growth would be around 19-20% on the last year basis. Maybe a little higher. I have not really gone on November numbers.
Mr. Rathod, hi. Good morning, sir. So you're saying H2 growth is going to be ballpark 20%. So that means on a full year basis, you won't be growing at around 30%. Usually, I mean, last couple of years, you've been growing the top line at 30%. And you also mentioned some price corrections. Can you explain a little bit more about this? I mean, what sort of pricing correction?
There are two things. One is the raw material pricing. So last year, February to June of this year, the raw material prices have come down by 22% on polymer, which is our major raw material. On our other consumer wear side, even on our glassware business, the energy prices, like main is the CNG gas, what we utilize, has come down from 110 rupees to around 65 rupees. So we have corrected our price on an average basis on all the categories except for writing instruments from around 5 to 13% on our molded furniture side.
Okay, so you've chosen to... Okay, got it. So basically you've chosen to pass on the raw material price decrease to customers. That's interesting. Again, my follow-up question is based on that. Is it because you find that the market demand is not that buoyant that you could retain a part of this raw material reduction? There's a 60 basis points increase in margin. See, I mean, if I go back in time and look at the older numbers, in FY21, at the EBITDA level, you were operating at a 26% margin. Right. So what are the dynamics like? Do you not see yourself going back there? Would you like to sort of keep prices lower to push more volume?
No, so if you see our last year FY23 whole year, our EBITDA margins were at 23.4%. First half is around 25.4%. So because of the raw material, whatever we passed, we have retained a little more higher margin than what we were doing in the last full year. So last year, the raw material prices were at the peak.
Got it.
So what's the margin band?
PAT margins, which were 15.9%, is in this first half is around 17.6%.
Got it. So at the EBITDA level, you are comfortable holding at around 25%. You'll not want to sort of push the margin back to 26%. Is that the right way of looking at it?
It could be over the years. It will definitely depend. Our price can go. The sales can top line can grow up from 20 to 22% also. If the raw material prices go up again and we correct our price upward.
Got it. So I want to talk about your capex plans because that's going to drive your revenue growth going forward. Now, you are in the process of setting up a glassware manufacturing facility, which will have an annual installed capacity of 20,000 tons of glassware per annum. This is going to be commissioned, I believe, in Q4 of FY24.
Right.
What is going to be the revenue potential of that in FY25? Assuming that the entire, the capacity utilization doesn't jump up to 100% in the first year. So what could be the peak revenue potential, and particularly in FY25, assuming a lower utilization?
So if you see on the glassware, the installed capacity being 20,000 tons, which will generate a sales of around 250 to 275 crores, depend upon the product mix. And for the next year, we assume that we will be targeting a sales of around 120 crores, because when the furnace starts in March, the main sales will start only from June, because we have to create the whole range once we go in the market, before we go in the market. So we'll get around 9 months flat, and 2.5 years flat, we would be exhausting the capacity for the furnace, what we have put, to convert into sales to around 250 to 275 crores.
250 to 275 crore is assuming 100% capacity utilization, but in year one, that's FY25, assuming 9 months of operation, you could do 100 crores, right?
Yes.
Okay,
Definitely.
So what about opalware? I think you have an ongoing capex there too. And all this gets housed in your consumer segment, which is 65% of your revenues. Can you talk about the opalware, capex? When does it come on stream, and what could be the revenue potential from it?
So opalware, we have already finished our expansion, which was in August when we put the new second furnace. And now the capacity to convert into sales, what capacity we have, would be around 400 crores around. The capacity is already taken fully.
Okay, and this 400 crore, when do you think you'll be able to start generating? Have you already generated sales?
We have already started generating in this year itself. Last year we were in shortage, and by next year we would be completely sold out.
So with all this coming through, your incremental revenue from glassware, opalware, what could FY25 top line look like? Assuming FY24, you end with about a 10-15% kind of a revenue growth given H1 and H2. What could FY25 look like? And is there any number that you have in mind?
See, I'll tell you, there are two ways of looking at it. Like when I say 9% growth in H1, if you see the volume growth would be much higher because of the raw material price correction. So our volume would have grown at 14% around. It would definitely depend 3 to 5% on our raw material pricing, but we target to grow at around 25%, 23 to 25% over the in FY25, having our addition of glassware also, and even our opalware, which has started now, where we have the capacity now to produce and sell it up to 400 crores.
Okay, all right. So we'll leave it on that note for today. Thank you very much for joining in and giving us a lot of detail about your business expansion plans. And good luck for the second half. Well, that is Cello World. The stocks are doing pretty well, given the commentary and given the, of course, all the expectations from H2 and beyond. We'll take a break, come back with more on the markets in just a bit.